Well, good afternoon from Chicago. My name is Don Prattle, the Director of Trader Development here at TradeStation, and it gives me great pleasure to welcome two very talented instructors, the directors of the Institute of Trading and Portfolio Management, Anton Kreil, who's the managing partner, and Malhotra, the senior trading mentor at the Institute of Trading and Portfolio Management. Now, the Institute of Trading and Portfolio Management prides themselves on having the most comprehensive online trading education courses that are available in the world. So we're very fortunate to have these talented individuals with us today for this TradeStation webinar. So after an hour, we should be able to generate some trade ideas for potential profits. Please remember that our presentation is for educational purposes only. All the symbols and trading ideas discussed by these instructors are for demonstration purposes. They are not recommendations. This presentation is not an offer or a solicitation of any kind in any jurisdiction where any TradeStation affiliate is not authorized to do business, including but not limited to Hong Kong and Japan. Active trading is not suitable for everyone, and options trading does carry a high degree of risk. It may not be suitable for all traders. Please take a look at the disclosure information in the PDF handout that I've made available in that chat panel, or you can review those documents on the TradeStation website. I also posted a PDF that contains the upcoming TradeStation webcast for the rest of the month and on into April. Are we already talking about April? Isn't that wonderful? Anyway, big trading day today. The Federal Reserve or Federal Open Market Committee made an announcement today. I'm sure our instructors will handle any questions on that. I'll be on the sideline answering questions in the chat panel about TradeStation or directing you to places at the TradeStation website where you can find those answers. We certainly want to make our guests feel at home, so we will work with them to answer those questions that you might have after the presentation. So, gentlemen, welcome to TradeStation.
Thank you.
Hi guys, Anton speaking. Can everyone hear me? Okay, great. So, just want to get, as Don did, a small disclaimer out of the way. ITPM is the website, Institute of Trading and Portfolio Management. Just a reminder that we're not an investment advisor, we're not registered with the US SEC. So anything in this presentation is not, should not be considered investment advice or a specific solicitation. Also, TradeStation, we do introduce our US traders to the TradeStation platform. We work together with them, so open disclosure there, and we don't receive any commission in the way of broker fees back from TradeStation. In fact, our deal with TradeStation or our introductions, our guys get 20% of their commission back every month in the form of a rebate direct to their trading accounts. So we pride ourselves on that, in that there's no conflict of interest. Just a bit about my background, and Raj will jump in a second. I started trading in the mid-90s in my teens. Went to University of Manchester, studied economics, and ran a retail trading portfolio, pretty much like all of you guys do now, except we didn't have as much information and as much technology. So it's a bit less sophisticated, but joined the market in the mid to late 90s, rode that bull market, managed to make quite a bit of money at university, about $100,000, and then was hired by Goldman Sachs a year before I completed my degree. So joined them after I completed my degree. Traded on Wall Street, traded in London on pan-European equities, market making and prop desks. Then I was hired, headhunted into Lehman Brothers in the roaring noughties, the good old days of the bull market, and then basically cashed out my career with JP Morgan. Didn't do anything really for 3 years, and then apart from making a TV program, which you might want to look at online, called $1 Million Traders. It's actually the most watched trading TV show in the world on YouTube. And then set up the Institute of Trading and Portfolio Management in response to a lot of messages that we got through personal websites, mainly requesting my services to basically teach retail traders. And we basically hired Raj a couple of years ago. Raj, do you want to jump in and discuss your background briefly?
Yes, sure. So I graduated from the Wharton School of Business at the University of Pennsylvania in '98. From there, I was hired at a hedge fund that basically my first job was to stand in the CBOE pit and make markets in the S&P 500 option pit. And I was there for about 6 months, and then they moved me to the upstairs desk because the more of it was I could see more being on the upstairs desk by running that book. And 2 years later, I moved to New York to join BNP Paribas as running the S&P options book. At the time, probably still is, the S&P was the biggest. It's the most heavily traded option market in terms of market cap and notional in the world. And that was before spider options, so that was when it was just a cash settled product. From there, 2 years later, I was headhunted away to Bank of America to run options, to run index options, and eventually all of institutional options trading. There, I was the youngest managing director they ever had. I was a managing director and a head of trading before the age of 30, which was quite an accomplishment. And my P&L, my average P&L there was something around $200 million for 5 years I was running the desk. And after the merger, I was hired away by Nomura to start their U.S. business. And I was there for a couple of years until I retired for a few years. I did some personal projects, did some of my own, some things I want to do on my own. But in 2015, Anton, through much convincing, convinced me to come work with him at the institute, and it's been great. I give seminars at least once a month. I travel around the country. I help students make money in their trading accounts. And Anton earlier talked about the conflict of interest. One thing that I really get out of this is I allow my students to give me trade ideas. So in terms of not having conflict of interest, our conflicts are aligned. I'm going to teach you how to do this stuff, and then you make money for yourself, and I will profit off your trading ideas.
So yeah, with Raj, it's a common thread that we have across the institute globally. We basically encourage our interests to be absolutely aligned. So the mentors themselves globally, because we have 8 mentors globally, their interest is to basically get the best out of all of their guys, because the more good ideas that their students come up with, Raj, like all the other mentors, is trading accounts as well, and we all make money together, and that's the whole point. So we have about 40 trading accounts across the world, and 370 institute traders. And institute traders are basically guys who have been through our course and then opened a trading account in the US with TradeStation, other brokers in the rest of the world. And then all of those guys come under one umbrella, and we can see everything you do on a read-only basis through the back end of the brokers' websites. So how are we going to do things today? Okay, so in terms of financial markets knowledge, we never know really how much knowledge there is on a call or in a seminar. So we're going to start with the basics. Why the vast majority of retail traders in the US lose money. It's an absolute fact that the vast majority of retail traders in the world lose money, and the majority in the US do. It's no different. The statistics are just slightly better in the US compared to the rest of the world, but there's reasons for that. We'll look at that now. We're also going to look at the approach that as professional traders we've been taught to take for the last 17, 20 years in terms of becoming potentially consistently profitable and generating high quality trade ideas. It's essentially a systematic process that professional traders would use on investment bank proprietary trading desks and also at medium-sized to large hedge funds. And then we're going to go into what's going on right now, how that systematic approach is applied, to the current market. And the systematic approach is essentially anchored in fundamentals. So we're going to look at some examples of fundamental themes that are driving the equities markets right now and trade ideas for the second quarter. And then we'll finish up with looking at a few things about what the Institute does and how you can actually learn how to do this properly for a very long time, so get a consistent flow of fundamentally driven trade ideas. Okay, so let's start. Contracts for difference. A lot of new retail traders in the US probably haven't come across contract for differences before. CFDs, contracts for difference, are very, very popular outside the United States. But they were actually banned in 2010 in the US after the global financial crisis. And that's because they're a highly leveraged instrument. And let's not beat around the bush. During the financial crisis, all retail traders lost money. Everyone just blew up their trading accounts because they were super over leveraged, and the financial crisis wiped everybody out. And they wiped a lot of institutional traders out as well, a lot of professional traders. So contracts for difference were actually banned in 2010 in the United States. And as a consequence, options have become a really popular instrument with retail traders in the United States in the last 6-7 years. Because typically, if retail traders want to trade physical stocks in the US, the margin requirements are really high. You're going to have to make a large deposit, and you're probably only going to get 33 to 50% margin requirements, so 2 to 3 times exposure on physical equities or futures. So Forex and commodity futures. With options, obviously, people can deposit a lot less margin and get implied leverage to the upside and downside of a stock. But what we found is this actually presents additional issues for retail traders. So what tends to happen is that retail options traders in the US tend to only use options for directional bets as a proxy for going long or short an asset. So, basic representation of long calls or long puts. And the main problem for retail options traders in the US is that approximately 70% of options expire worthless. So, for example, if you're long call options because you just want to represent a bullish view in a stock, even if the stock grinds slowly higher towards your break even over your time to expiry, the call option can still end up expiring worthless. So you can end up being right, but make no money and over the time period, because you need volatility, and opportunity is created by the volatility before the expiry. So it needs to happen before the expiry. So there needs to always be a catalyst that could potentially make the stock move higher before your expiry. And using directional bets on option strategies to represent a bullish, so long calls, call spreads, or bearish long puts, put spreads, that view in a stock really shouldn't be implemented just because you don't have enough money to get meaningful leverage in a physical brokerage account. Because as soon as you're long an option, you're basically long volatility and the clock's ticking, the time is against you. So again, you can end up eventually being right in your view that the stock could go up or down, but you end up losing money. So the obvious question in the US is, if the vast majority of options expire worthless, why don't retail traders just sell options every day and make an easy income? And this is a strategy pushed by many trading educators in the market, in the retail market, as a way of making income. And this is one of the biggest fallacies you'll ever get taught as a trader, or a retail trader, or a beginner, is that the market is like an ATM and you just have to turn up every day and you can take cash out of it and you can make a guaranteed income every month. It's absolute nonsense, because it totally depends on volatility. If you're long or short an asset at a certain price and the price just doesn't move over the time period that you have the trade on, well, you're continually buying and selling that asset at the same price every day. You need volatility to make money. So income or taking money out of the market is totally dependent on volatility. But you'll never hear that as it's a truth that nobody wants to discuss. And it's the same with selling options. You know, you can win 7 to 9 times out of 10, but the times that you lose, you're going to lose big. Because you'll just end up going longer or shorter stock that you don't necessarily want to have a position in, because you're just taking the position to try and get some income out the market, and you've got considerable gap risk. So the market closes, you've got the position, and then, you know, let's say your implied longer stock through options, and then the stock just has an announcement overnight, and it's down 40% the next day. You're basically going to end up with a big loss. So, selling options, or let's say you're short a call option. Obviously, we're selling options here. If you're short a call option and the stock just goes up 40% overnight, you're going to end up with a hefty P&L loss in your account. So you end up just blowing up, and this happens repeatedly over and over and over again. So that's the first problem. It's representing options, using options to represent trade ideas correctly. You need to know the ways that you can actually use them properly to represent trade ideas, and there needs to be a marginal benefit to having the options position over just owning or shorting the stock. And if there's no marginal benefit, just because you don't have the money to put in a trading account to get the leverage, you shouldn't have the position. So that's the first problem. The other problem is actually just a major problem globally with retail traders, which is just a lack of education on how to generate a constant stream of high quality trade ideas. You know, one of the problems with retail traders is that most people obviously have full-time jobs, or they're running their own businesses, and it's really just a hobby on the side. And time is a problem for retail traders to dedicate to coming up with consistent trade ideas that are good. So what tends to happen in the US and in the rest of the world is that people try to shortcut to generate trade ideas by simply looking at potential news stories that are expected to come out over the course of a particular time period or calendar. And the typical mistake is to conflate a publicly announced or diarized event with a genuine catalyst that's not being discounted into price. And you'll see that we've highlighted the word expected there. So, for example, buying an option a few weeks before earnings because you think a company will miss or beat earnings. Well, it's not like the world doesn't know that the company's going to report on a certain date. And all analysts and professional traders and hedge fund managers are all fully aware of the consensus range and median. And analysts are generally creeping their estimates either up or down ahead of the earnings. And options prices through the market makers are already pricing in the potential for surprises if they expect a potential surprise to happen, or the probability is increasing before earnings. So that's a single stock example. In terms of a macro example, you know, non-farm payrolls is a very good example of something that's pushed by everybody in the market, brokers, educators, every month as this panacea macro number that everyone has to trade around into and out of. It's actually what's called a coincident indicator in the numbers, in the market. Sorry, it's not a forward-looking statement. A coincident indicator is basically a backwards-looking statement. It's telling you what happened in the past, in the last month. So, for example, like buying index options ahead of non-farm payrolls every month, the world is absolutely fully aware of the date, and they're fully aware of the consensus and where all the economists are. And also, the market's received weekly jobless claims for weeks before. So NFP, again, is a coincident indicator. It's backwards looking. And there's very rarely surprises. And you'll often hear a saying on the professional side that with NFP, the first move is the wrong move. So if the market goes up, sell the market on NFP. If the market goes down, buy the market on NFP, because there's always a blip either way. And that's where the retail or dumb money is trading around NFP. So it provides basically professional traders with with liquidity that they can use to get into or out of positions that they want to do. So really what you should be doing, and this is what you're taught, you know, if you go onto a professional trading floor like a Goldman Sachs or a hedge fund, everything is anchored in fundamentals, and it's about an 80% weighting in terms of your overall systematic approach to fundamentals. You have to have a fundamental view on a stock, and it has to be driven by both macro and micro fundamental drivers. So both top down and bottom up. So top down, you need to have a macro view, and bottom up, you're looking at the industry that the stock is in as part of the overall market, and you have to have a view on the sector or the industry. And then you have to have a relative view on the stock relative to its peers within the sector from a bottom up perspective. And this is the most important thing. If you're fundamentally bullish on something, you should never ever be short just because the chart doesn't look good short term. It's one of the biggest mistakes retail traders make. It's doing everything backwards. So it's starting, for example, with trade structure and timing, and then looking for fundamentals that justify the position that they want to have, because a chart might look good for the next week, and looking for ways to justify their view. And professionals do it the other way around. It's what the biggest mistake you'll make is, you know, for example, going into a Goldman Sachs and walking into the morning meeting at Goldman Sachs and sitting down with another 30 traders, and everyone goes around the morning meeting and discusses their positions. And then you're short a stock that you're bullish on, and you're going to lose money that day. Well, it's actually a sackable offense on a professional trading floor. So if you're bullish on a stock and you're telling everyone that you're short, and when the market opens you're going to lose $1 million, it's a sackable offense. And fundamentals, you know, if you're fundamentally bullish on something, you should be looking to be long and looking to time your trade once you have a fundamental view, and then you're timing your entry. So don't do things backwards. Charts don't generate trade ideas. They're backwards looking. You're looking at price and volume from the past. What they do is they help with timing and risk management. It's very important you get that right. In terms of trade structure, once you have a fundamental view and you think your timing is good, you've got to question how you actually structure the trade. Do I simply own or short the stock? Is there a marginal benefit to using options? Are there catalysts in the time periods that I'm looking at? Will there be volatility beyond what I believe and the market believes could be over the time period that we're looking at? And if there's no incremental catalyst that you can identify beyond publicly known events where you believe you have an edge, it probably means that the option is fairly priced, and you should avoid having an options position. Again, we're back to this point that you don't have an options position just because you don't have enough money to deposit on margin to get the size of positions that you want to get. There has to be catalysts, and catalysts that are outside the realms of expectations. And then once you have a position, it's all about risk management. Always ask yourself this question before you go into a trade. What changes my thesis? If I'm fundamentally bullish on something, what makes me drop that view? List down all of the potential things that could come out which will change your view while you have a trade on. And then also you need to plan. Where or when do you actually cut if things go wrong? Or where and when do you take profits if things go in your favor? And you need to stick to it. And you need to have a repeatable process and keep repeating that process. So the other thing is diversity as well. You know, typically when you open a retail trader account at a retail brokerage house, what you'll often find is every retail trader either has 1, 2, or 3 positions. It's not good enough. You're not diversified enough. because what you need is negative correlation in your portfolio. You need to always be in a situation where you can lose money on one trade, but there's enough positions in your account where if you're losing money on one trade, another one can pay you. And then over time, if you're trading well and coming up with lots of good trade ideas, if your timing, your trade structure, and your risk management is good on top of your fundamental views, over many, many trades, you're going to make money, and losses are just a part of the game. So you should actually have 8 to 12 positions at any one time in your portfolio. So a mixture of long and short with negative correlation. Now we come back to this timing issue. Time is an issue for retail traders. You should look to have, in terms of work, to generate trade ideas, because if you're going to have 8 to 12 positions in your portfolio at any one time, and you're working a full-time job, or you're self-employed, you're going to have to dedicate time outside of that, and your time you need to work efficiently and generate trade ideas and concentrate on what's important. And this is one of the toughest challenges for retail traders, because you are obviously working that full-time job, and it's really, trading is just a part-time hobby. So it's very easy to slip into bad habits, you know, getting lazy and start doing everything the one way round, as we've discussed, you know, pulling up charts first, taking a view on the chart, and then looking for news items or fundamental items that justify your view, and then closing your mind off to all of the possibilities of the trade going fundamentally wrong. Signing up to receive daily hot stock tip sheets, you know, from so-called educators or forums, and basically relying on other people to give you trade ideas. Taking a punt on an option to represent a badly thought out trade idea is just writing a check to the market. Your account's just going to go to zero in a short space of time. And if this is your approach, you're just not going to last long. So it's absolutely necessary to learn how to generate trade ideas properly yourself, and only rely on yourself for trade ideas. And it's a very difficult discipline to get to grips with when you're starting out. So now we're going to look at examples of fundamental themes driving equities markets for Q2. And what we've got here is a chart that's pretty much driving everyone's views in the market at the moment at an index level. So when we're thinking about the United States S&P 500. Obviously, long-term interest rates are a hot topic over the last decade. And you can see here on the right-hand axis, long-term interest rates. On the left-hand axis, you can see the price-earnings ratio of the market. And currently, it's around 28 times earnings. And everyone's looking at this and comparing it to the tech bubble of 2000 and the 29 bubble before the Wall Street crash. And looking back and saying, okay, the market is expensive or overbought. And you're going to hear this a lot again in 2017, as in the previous 6 years, i.e. the market looks fundamentally overbought. The problem is this: the market's actually very different now compared to times in the past where it's been priced at this level. What we've got here is the Citigroup Global Earnings Revisions Index with a 20-day moving average, and it's showing you that earnings estimates and earnings of the S&P 500 have been creeping up aggressively since that low there at the beginning of 2016. Excuse me. And going into earnings season now, this is what's scaring everybody, because picking tops, especially in this type of market when earnings revisions are going up, is very, very dangerous. So you have to be really, really careful with overvalued markets in general, but with this market in particular, because EPS is rising and catching up to price, and the market is basically paying the price ahead of time. So what's actually happening is the market's going up in anticipation of earnings rising aggressively in the future. and earnings are catching up to the price of the market. And the way you have to think about this, it's a very typical retail trader error when we talk about things that are cheap and things that are expensive. So I'll give you a good example of this. Think of a stock that's $10, okay? And think of that stock has $1 of earnings. And the stock is operating in a sector where let's say there's 20 or 30 competitors, and it's trading at the average PE multiple, so the price earnings multiple of the sector. So basically it's an average stock in the sector that trades at $10 and has $1 of earnings. Now think about it in period 2, where between period 1 and period 2, in period 2 the company's going to report EPS. If the price goes up to $20, it's trading on 20 times lagging earnings. But if EPS estimates go up to $2, it basically stays on a 10 times earnings all the way between period 1 and period 2. And then they report $2 at the end of period 2. Well, that just means the multiple of the stock hasn't changed. And a stock can basically go to infinity if earnings go to infinity and stay on exactly the same multiple. The point here is that the market likes earnings growth. That's what happens in the stock markets. Money chases earnings growth. So if a stock relative to its sector has superior earnings growth and it keeps hitting their earnings continuously, what happens over time? Well, the market pays a premium for that stock relative to everything else. So when you see, for example, we'll go back a couple of slides here. When you see the market on a multiple here at 28 times, you have to ask yourself, is it justified? You don't ask yourself, is it cheap or is it expensive? Because a stock can be expensive forever. And if you short that stock at $10 and the EPS goes up to $2 and you're short all the way up from 10 to 20, you're obviously going to lose a lot of money, but the multiple stays exactly the same. So the question here is not whether the market's cheap or expensive. It's whether the market is priced as it is fairly and whether it's justified. So let's have a look at a few things here that are going on in the world and see if we believe that the market's fairly priced or justified here. Well, we've already seen here that that EPS estimates are going up fairly aggressively into Q1 earnings season. You've got to look at the US relative to the rest of the world, because the US is like a stock relative to the rest of its peer group, which is other geographical regions globally. What does it look like? Well, there's a major problem outside the United States with negative interest rate policy. In the Eurozone, Japan, Switzerland, you've basically got short-term negative rates, and rising rates in the US is causing dislocation in the world. Essentially, and I'll give you a real-world example of this, in my corporation in Singapore, we've got multiple currency bank accounts. And last year, I was charged 30 basis points up front for holding euros by my bank in Singapore for the entire year. And I couldn't believe what I was seeing on the bank statements. So I had to go in and see the manager. And they said, yes, basically, if you hold euros, you're getting charged 30 basis points a year as a corporation in Singapore to hold those euros. So obviously, I want to get rid of my euros. In Japan, it's about the same, and in Switzerland, it's even higher. Switzerland now is about 40, 50 basis points if you're holding cash in Swiss francs. So essentially, what you've got outside the US with the major countries, major currencies, is corporations and high net worth, ultra high net worth, and funds don't want to hold these currencies because they eat into your performance. You get beaten by inflation. And there's very, very few places in the world to hide. So this is one reason why money is pouring into the US. Additionally, interest rates in the US are expected to rise, over the next 1 to 2 years. and pretty much each rise is a given at the moment. Because whether you love him, hate him, or you're not bothered, Trump is injecting, or is expected to inject, very aggressive fiscal helicopter money into the US economy, with the simplification of the tax code, raising of the lower end of the tax threshold, lowering of corporate tax, repeal of Obamacare, infrastructure projects, and lowering of regulations. And this puts, on a combined basis, significant dollars back into pockets of consumers and businesses in the US. And also, something people aren't really thinking about is this corporate tax rate. If the corporate tax rate does go from the 30-35 number down to 15, it puts the US on par with geographical regions like Asia, where for the last 25-30 years, money has been leaving the US in terms of corporate money, businesses, and setting up in places like Asia where the corporate tax rate is lower. And people aren't really thinking about the amount of money that could flood back into the United States if the corporate tax rate is equivalent or lower to the rest of the world and Asia. So there could be a huge repatriation of corporate and business money back into the United States. The other thing people aren't really thinking about, which is not on this slide, is the quality of the balance sheets of US companies relative to the rest of the world. The cash levels on balance sheets of large corporations in the US is the highest it's ever been, and the balance sheets are incredibly strong. That's why you're seeing in the last couple of years significant money being released for share buybacks. So all of this puts a huge base under US equities on a relative basis versus the rest of the world. And money just simply has to go into the United States. So when we look at that number, the 28 times multiple, money is basically just chasing earnings growth, as it has done forever up to this point on a global relative scale. So it's actually pretty justified. And if earnings continue to creep higher and higher in the next 1 to 2 quarters, all that's going to happen is the market's just going to grind higher and rates are just going to keep going up. And then you could just keep getting this fiscal helicopter money put into the hands of families in the United States and businesses. And it's much more likely that if companies are going to hit their consensus earnings for Q1, Q2, they're just going to continue to rally or jump aggressively due to the additional catalysts as well that are identified on earnings calls by management. So extra information, extra catalysts above earnings. So I'm going to hand over to Raj in a second to start going through some of these potential trade ideas that we're looking at for Q1, end of Q1 and Q2. But just a reminder, we're going to use some specific examples here, but they're not actually specific recommendations. What we're doing here is basically just highlighting how the trade idea generation thought process works, and use those current examples as a guide as to how that process actually can be put into practice. So they're just a narrow subset of multiple trades or positions that you could implement via stocks that exhibit similar fundamentals. So I want to encourage you to do your own work, encourage you to expand on these highlighted themes, and try to find other positions in stocks within the sectors that are competitors or peers of the stocks that we show you. And just a little reminder again, Institute and TradeStation aren't responsible for any losses here that you incur from taking the information from this and doing your own work. And with that, I'll hand over to Raj, and I'll see you at the end of the presentation.
All right. Well, thank you, Anton. Thank you, everybody, for joining this webinar. So right here, I want to go over some themes in the equity markets for Q2 and just some potential type trades you want to be looking at going forward. So one thing that you hear a lot is that that bank stocks are very expensive just because they're near all-time highs, and you hear that across almost all equities. But if you think about how many times have stocks been at their all-time highs, they're constantly near their all-time highs, and just because something is an all-time high today doesn't mean it can't be at a higher high tomorrow. People like to look back too much at where a stock has been rather than where a stock is going. In a lot of ways, where a stock was a week ago or a year ago or 5 years ago is completely irrelevant. All you want to be worried about is where stuff is going. So, in terms of bank stocks specifically, one thing that's been common, we've talked a lot about the Dodd-Frank and the Volcker rule and regulatory announcements, which have been a tailwind to bank stocks since the election. So most investors have been going for investment banks. Names like Goldman Sachs and Bank of America are pretty obvious choices. Bank of America, stock that I know obviously very well, stock I have a lot of, is up close to 50% since the election, which is obviously a great return. But some names that have been underappreciated or that have underperformed are Canadian banks. Now, Canadian banks have historically trailed U.S. markets just because of the type of structure that they are. But names like Royal Bank of Canada and Bank of Montreal are less obvious, but they could clearly have more explosive upside. You know, as I said, Bank of America has rallied 50% since the election. Those two are up between 15 and 20%. So one way to possibly profit off this is looking at out-of-the-money monthly calls, which look like probably a pretty good risk-reward play, given what's happened. And going out 3 to 6 months probably give you enough time to digest the additional regulatory commentary and updates from Congress and management, etc. So let's look at a chart. Let's look at a option screen here. So looking at this chart, look at the screen specifically. You look at the 80 calls out in June for Bank of Montreal. Earnings are in late May, so potentially the June 80 strikes might be an upside play. They're offered at $1. In fact, they're actually offered lower. I looked at it earlier today. And as you know, there's not a lot of downside. It's sub 14 vol, which is near historical lows. Not cheap, but near historical lows. And should you get a 15% rally to make up part of the rally that you had in the U.S. banks, you could potentially make 7 times your money, going from 76 and change to $88, which wouldn't be a crazy move in 4 months. Royal Bank of Canada probably looks like a very similar risk-reward profile as well. So moving forward, another theme that we have identified, and this is a bit more of a non-consensus theme. At the Institute, we like to look at themes that the whole market's not talking about. And one thing that's really one thing that you might be hearing about that Trump talks a lot about is trying to improve economic conditions in the U.S. inner cities. And while that's obviously a great thing for the country as a whole, there are some economic conditions that there are some losers in that equation. So one obvious way, though, to play a improving economic conditions in U.S. cities is to look at improving credit quality or credit scores in subprime. That's what most guys are looking at. But in that case, there will be beneficiaries, but it's a crowded trade with catalysts. So you think about that, who suffers in the short term, and who has potentially crowded long positioning from yield hunters of 2015-16. So if conditions should improve in the inner cities, one result of that is that food stamps will go down. There will be less food stamps given out as people come off welfare, as the very poor become less poor. Some of their food stamps are taken away. Also, as the poor move to the middle class, they obviously will also lose food stamps. So with a decrease with food stamp participation, you can see low-end retailers possibly hurting from that. You've seen that already somewhat. Target had a profit warning last month. I think they're down 15% since their earnings call. And and they've lost not only just from the move from brick and mortar retail to online. You can see it also in Dollar Tree and Dollar General. They've issued profit warnings. And one thing that they're not citing, that's not really priced in yet, is the decrease in SNAP participation. Like Walmart alone, 18% of their sales come from SNAPs. So obviously, any decrease in SNAPs should possibly hurt their bottom line. And also, as people go from poor to middle class, some of them stop shopping at Walmart, and that's when they go into buying. That's when they start stepping into places like Whole Foods. So, looking at risk reward play in retail could possibly be a way to profit off of this theme. Now let's look at this screen right here. So, if you look at Walmart, earnings are in late May, so I would possibly look at the June 67.5, 62.5 put spread. It's a $5 wide put spread. As you know, Walmart's probably not going to go to zero. Walmart will exist in 6 months, no matter what happens. But in terms of this play, you could pay $1.09 for a put spread with an upside of $5, and it's a payoff of more than 3.5 to 1. And should the stock sell off a little over 10%. Now that's not a big move in Walmart. As I said before, it's not going down. Probably not going to be cut in half, but it could certainly drift down, given the fact that retail just in general has been weak. Like if you look at today, there's a lot of retail names. There's general weakness in retail, especially in anything with a lot of brick and mortar. Walmart's done a good job of actually moving to try and become more online. But having said that, it's still the biggest brick and mortar retailer in the world. Another thing about this spread is you take advantage of the skew. As if you look at the right side of the screen, you're buying a option with a 19.58 vol and selling one with 21.7. So you do take advantage of the skew. You are buying an option and selling an option that's 2 vols higher. So that's why I like doing this. I'd rather do this spread rather than outright, because in my mind, Walmart does have some limited downside, but you could easily get a drift down to 62.5. Although, and there is probably a pretty high floor on Walmart itself. Now, in this trade, we don't ideally want Walmart to. Now, in this trade, we ideally want Walmart to have a profit warning or cut their dividend. But by buying the spread, we hedge ourselves by this not happening and Walmart just drifting lower over time due to the expiry because of profit warnings from other competitors. As you know, when one company issues a profit warning, it tends to bring down the whole sector. And who's bigger than Walmart? So that's a theme you've been seeing as well. All right, here's theme number 3, and this one's my favorite. So as there's been a lot of talk about corporation tax, as corporation tax gets cut, one potential beneficiary we see is getting upside to small and medium enterprises. Their bottom line's improving, and once those companies improve, what are they going to? They're going to spend. They're going to reinvest that money probably in something related to B2B, business to business. And software, and one industry the whole market has seen a huge bull market has been the SAS companies, the software as a service, cloud-based computing. That whole sector has seen huge growth in the last 5 to 10 years. And here's an aside to this. Here, if you're looking for career advice, if you want to be if you're a pretty personable man or woman, with some technical expertise, instead of going to Wall Street and starting to sell options, you should go go work for a software company. A friend of mine in this year alone, he's has 10 times as much comp as he did last year just by selling software for Salesforce. And if you're a person that wants to be entertained, you should go to work for a Fortune 500 company and then be in charge of allocating what software is sold, what your company buys, because that's the other new Wall Street. That's one place where you're getting all kinds of perks like dinners, dinners, ball games, etc. But I digress. So what you want to look for in this sector is super expensive companies that are trading on high PE multiples, because they're investing all their profits back into growing market share. See, these companies, they're not earning stories, they're revenue stories. All these companies they're just trying to gain market share, and at this point, it really doesn't matter what their earnings are. It's much more the fact that they just keep increasing their revenues. That's all what the market really cares about at this point. It's similar to the tech boom early in the early 2000s. So a good example, an obvious example, was a company like Salesforce and Oracle and other similar software companies. But however, one other way to possibly look at this is look for really aggressive turnaround stories. Companies with lower market cap and they're losing money. A company like Tableau, or the ticker DATA. For example, like Oracle itself had 10 acquisitions last year. The biggest one being NetSuite for about $9 billion. So Oracle and Salesforce and SAP, they're constantly looking to grow their revenues and their top line by acquiring companies, and I don't see any reason for that to not continue going forward. So looking at quarterly 5 to 10% out of the money call spreads or just outright calls as an outright bet is probably a pretty cheap punt. So let's look at a chart right here. So this company itself, it's fallen almost $80 from its all-time high. It peaked out at about $129 in summer of 2015, down at current levels. So in an aggressive turnaround story, anytime you want to play a turnaround story, you don't want to do it quickly. You want to give yourself time for that thesis to play out. Because just because you realized something today doesn't mean the market's going to realize it today. A lot of times it takes a long time. Remember back in The Big Short, Christian Bale's character, his trade of getting short the housing market was one of the greatest trades of all time, but it took him 3 years for him to be right. So you clearly need time on your side. So an aggressive turnaround story, I would look further out on the option chain to something like January 2018. And in 2018 upside calls might be a good play here. I mean, should this stock even retrace half of its losses, the January 60, 65, or 70 calls, if you look at the red box on the right, all of them have very big upside and a very good risk reward. And now that this company is at under $4 billion market cap, this could clearly be this one could clearly be an acquisition target. As you know, to acquire if Oracle or Salesforce paid $6 or $7 billion for this company, that's nothing to them given the size of their company. Cool. So with that, I guess I'll give it back to Anton.
Hi guys, Anton back again. Okay, so Raj showed you three interesting potential themes there, and you see clearly they're fundamentally driven. And this is really straightforward for guys like us because we've been doing it for years in terms of identifying fundamental themes in the market, timing them, structuring the trades, and managing the risk when we have them on. But it's not so obvious, for retail traders to go through this process. So we wanted to show you the examples there of how this process actually works. So if you remember this this slide here that we looked at earlier, everything should be anchored in fundamentals. If you want to be long or short something, You should never be the other way. Time your trades correctly, structure trades. If there's a benefit for putting an option position on, then do so. If there isn't a benefit or catalyst beyond publicly known events, then don't. Don't take options positions for the sake of having them, just because you don't have the cash to have a physical leverage account. And then when the trades are on, have diversity, have a plan, have good risk management. So with that, guys, we're coming to the end of today's webinar. Just want to point out what we do at the Institute in terms of teaching fundamentally driven trade ideas. We have a bunch of options, essentially. So the online education, we have 2 courses: professional trading masterclass video series. That's basically stock market, both macro and micro. So applying the systematic process in the stock market. The price range there is $1,500 to $3,000. Forex trading masterclass, that's all basically macro and currencies, same pricing structure. We do 3-month remote mentoring programs, which is all over Skype with either Raj or our new hire on the West Coast, Ben Green. The price for that is $14,000, and you get the PTM and PFTM video series included. But we also update your spreadsheets for both courses for 12 months. So that's a rack rate of $2,000. And the total value included is basically just under $8,000. And if you wanted to do the video series online first and then upgrade to a program later, that's totally fine. We're very flexible. Essentially, the upgrade price is $8,000 if you've taken both courses. Another thing that we do is we do one-on-one vacation training programs in the US now for both US and Canadian students with Raj and Ben, where you basically spend 9 days on location. The last one we've just completed in Florida. We had a bunch of guys staying in a mansion there for 10 days, and Raj and Ben give one-on-one training, and then when everyone goes back home, you get the 3-month program afterwards. So that's basically a price on application. If you want to know how that works, then you just send us a message through the website, through the bottom link there, through to the contact us link, or through the mentoring link halfway down the page. So we've got the general website there, itpm.com. We also do free seminars in the US every quarter. So we're doing about 5 or 6 seminars across the US every quarter now, where Raj and Ben turn up for a couple of hours and show you some cool stuff. So if you want to have a look at what's going on there coming up in the calendar, just go to the seminars link on itpm.com/seminars. The online education is available at /education. As I said, mentoring programs, you can inquire through the link. Have a look at more information on trader-mentoring. Institute trading accounts, if you want to look at the benefits of becoming an institute trader, go to that page. We have all our contracts with our brokers on there, which is basically, no educator does this in the world, where they have all of their contracts up. You can actually see that there's no conflict of interest. So all the contracts are signed with our company in Singapore. And then also check the FAQs out. The FAQs are an amazing resource. There's tons of information there. Go to itpm.com/FAQs. And if you haven't had your questions answered, then send us a message through the contact form. Send all of your questions in one message, and our guys in the London office will get back to you to schedule a call, and we'll be happy to answer all those questions. Here's our upcoming seminars. We've got one left this quarter in New York. Raj is going to be speaking at the New York Seminar and Conference Center on the 23rd of March. Then you can see we're going to be in Atlanta in April, LA in May, Chicago in June, and New York in June. If you're interested in coming to London on the 1st of April, we have basically what we call an annual super conference, where basically we fly in all of our mentors from around the world for one day, and everyone presents throughout the whole day. I'll be there myself doing 2 presentations. So if you fancy doing that, hop over to London, get yourself a cheap hotel room, cheap flight, and we'll have an amazing weekend. Next, vacation program, mentoring program, is going to be in July. As I say, we just had the one in Florida. This one is going to be held in Panama City, Panama, not the Panama in Florida. So we're actually going to go to the country Panama. What does it include? Both video series, 12 months data subscription, 10 days with Ben and Raj, all your accommodation, transport, meals, 3-month mentoring program afterwards, and you get your individual track record housed by the Institute, and also everyone on that program, we essentially run it like a trading desk, so we put Institute money behind you as well. So if you want to know how that works, get in contact, go through the contact form or the trader mentoring form. If you want to check out the latest one, go to YouTube and type into YouTube, make me a trader. I'll put this in the chat. Make me a trader, Florida documentary. I've just put this in the chat. So type that into YouTube. And oh, you've got the link as well. Okay. So yeah, just click on that link or put that into the search field, and it'll come up. The video went out yesterday, and a lot of people are really enjoying the documentary. So it's about an hour and a half, but well worth watching, as it shows you everything that we're doing. So guys, thanks for attending the webinar today. If you've got any questions, I'd be happy to take some for 10 minutes. And obviously Raj as well. You'll be able to type questions into the chat field.
Don't all ask at once.
Well, hi guys, this is Don on the side here. Way back in the beginning, I think before we started, Mike asked, what hours do you usually trade when you're in Thailand? And you ran through that. It's almost like a non-stop trading day for you. But Anton, why don't you run through what your trading day is like? I find that very interesting.
Yeah. So, I mean, the time zone in Asia is pretty punishing for a trader, but the lifestyle is much better. So, weather here is amazing. Everything's a great lifestyle, but you don't want to be chained to your desk too much. So essentially, on the time zone here, Asian markets open between 9 and 10 a.m. But the Asian markets are much more of an investor's market. There's not a lot of volatility in most of the markets in Asia, and liquidity is really poor as well. So if you're trading with a large amount of capital, you're not really trading short term. Anything below a time frame of a couple of weeks is quite rare, because it's much more of an investor's market. So during the Asian day, during the Asian trading session, you're not really doing much. You're kind of like sitting on your hands and doing fundamental research. Things really only start kicking off when Europe opens, which is 4 o'clock our time. So I'll generally get going around 3, 4 o'clock in the afternoon. And if there's short-term opportunities in Europe, I'll try and take advantage of them, obviously. And then take a break around 7:30 to 8:30 p.m., have dinner, walk the dogs, and then come back to the desk, and the US market's opening at around 9:30 to 10:30, depending on the time of the year. And waiting, economic numbers come out before the open. It's generally trading, watching the market till about midnight, 1 a.m. And very rarely do I stay up till the US close, and then get up again at 7, 8 o'clock in the morning. So it sounds more punishing than it actually is. But I mostly work from home, have an office at home and have an office downtown. Tend to go into the office once or twice a week. But yeah, working from home is nice because I can just potter about the house during the Asian session and rev myself up for Europe and the US. And it doesn't really affect lifestyle too much. But it can be quite punishing when big things happen. So for example, like last year, the Brexit scenario was obviously a big inflection point in the market. And I was basically up for 36 hours trading that. But it was an amazing situation because, after the referendum vote came through, the market had 9 hours to figure out what the opportunities were. And then the market still presented massive opportunities, so there was massive dislocation in stocks relative to currencies in Europe, and especially the UK. So I had to stay up for 36 hours to do that. So it depends, what's going on, whether there's big inflection points, big volatility. But generally, the Asian session is an investor's market, and you don't really do much. You're just managing portfolios, more longer term. And the short term stuff, the opportunities come more in Europe and the US, and you have to be ready to pounce on them, regardless of what the clock says. So, I mean, what we're doing in terms of portfolios, we've got 40 accounts in the Institute, which are corporate trading accounts across brokerage platforms. And we run inside the Institute about $10 million on margin. And good traders that we find with track records that have come through the Institute, we don't give money to guys outside the Institute. So guys who have come through our education, open trading accounts, and got a minimum 12-month track record based on the proprietary metrics that we teach. We actually give money on power of attorney to guys who meet our criteria after 12 months. So we have a portion of that managed by Institute guys. So I manage that, and Institute guys manage that as well.
So Anton, you want to talk about John C. and Mark C. They're basically asking about technicals. You want to answer that question about timing and technicals? And I'll answer a couple of the other questions.
In terms of technicals, my perspective is I've been a retail trader, then a professional trader on investment bank, market making, and prop desks, and then taken a break and then gone back as essentially a retail trader. But I'm just trading through my corporation in Singapore. What I've found is, over the years, technicals are a massively oversold solution to retail traders to get trade ideas. And cutting straight to the chase here, but fundamentals in any professional trading environment, so whether it's an investment bank, prop desk, or at a medium-sized to large hedge fund or a pension fund even, mutual funds, the fundamentals are 80% of a systematic process, and technicals are about 20%. And what it is just fundamentals plus timing. So technicals are used by professional traders to help them enter and exit trades that they have fundamental views on. And think about it like this, right? Imagine you're a senior trader at Goldman Sachs, right, or a large hedge fund, and you walk into the morning meeting and you've got a $30 million position long in a stock, and it comes round to your turn at the table to speak about your positions. And you get asked by the head of trading, head of Europe, head of US, so what's the story? Why are you long $30 million of this stock? If your answer is because the 15-minute MACD crossed the 30-minute MACD at 4:25 yesterday, just before the close, I've got news for you. You're getting fired. Like that's the way the professional trading approach. That would be the approach from a professional trader. You get fired. That's the last thing people want to hear. You've got to have a fundamental view on things, stick to your fundamental view, and technicals are used for timing. And everybody runs long-short portfolios, and the time horizon is 1 to 3 months. So we're looking mostly at 1 to 3 month volatility and saying, okay, I want to enter this position, long or short, for at least a month, and I need to be paid within 2 to 3 months, otherwise I'm just going to trade out. And if it pays, then you might consider, adding to the position. But, if a stock, for example, is, and this is another, risk, it's more of a risk management thing that retail traders get wrong. If retail traders are actually good enough to realize that what you should be doing is managing a portfolio, drawdowns in terms of risk management is very, very important. So let's say, for example, you've got a $100,000 portfolio, and every position in your portfolio is a 10% position, so 10 grand. So let's say you've got 5 longs and 5 shorts. Now, what happens if one of your longs goes up by 100% in a year? Well, that's if everything else stays the same. You know, that position is now 17, 18% of your portfolio. And if it doubles again, you're going to end up having a position that could be 40% of your portfolio. And unfortunately, that isn't portfolio management. You know, that's too much risk, because if you have a drawdown of 30 to 50%, you could end up being down 12 to 20% in your portfolio very, very quickly, you know, like if one piece of news comes out. So this is why, for example, you know, everybody looks at, you know, great stocks with amazing stories like Apple and Amazon, you know, all these stocks that have gone up by multiple times, but hardly anyone's made any money out of it, because the drawdowns are so severe at certain times. And if you're managing risk properly as part of a portfolio, which is the way professional traders trade, they build portfolios long short and manage the risk and trade inside the portfolios, and they manage risk properly. And this is the reason why very few people have made money out of these stocks over the medium to long term. So take a fundamental approach. Everything should be anchored in fundamentals. You can never justify to yourself why you're losing money. You know, if you're buying and selling stuff because the chart might look good, and you got an email from a broker or an educator circling a couple of areas on a chart where there was resistance last week and support the week before, you know, it's like, no shit, Sherlock, I can draw that too. You know, it's like, it doesn't add any value to your life, right? And
yeah, I'll add something to that too. I think technicals are a way over. It's not important. It's very not important to me when I'm making a trading decision, because when I'm looking at a trade, I'm looking to make 20 to 30% on a trade minimum. If not, I won't even bother looking at it. So I could care less if I'm going to buy, if it's 2 or 3% on the way in or way out. That's my slippage. To me, it's totally irrelevant. And I think what fun technicals, it's almost in terms of society. I think younger people have just become so lazy these days, where they just want a technical or a basic computer program to tell them when to buy and when to sell a stock without doing any actual research on the stock. And I think that's kind of a fundamental breakdown in our society, and that's why, and because of that, I think that's why technicals have become so important, or why it's been pitched to so many retail traders and why they're losing money. And,
you know, this is the catch-22. This is the catch-22 situation for retail traders, is that, you know, you've got your full-time job, you've got your small, medium-sized business that you're running as a self-employed individual, and you don't have much time during the week, you know, to actually go out and fundamentally research stocks and what the market in the wider context, to understand what's really, really going on, and even have a chance of having an edge in the market. The point is that disingenuous, bad people, and especially people with conflicts of interest, know that. They know that you're short on time, and they know that what they can do to make quick money, to get you to follow trades that they want you to follow, or to pay them commission, is to just tell you all the things that you want to hear, which is, look at this line on a chart. All you have to do is buy when the green line crosses the red line, and sell when the red line crosses the green line. And, you know, just use that indicator, or use a mixture of 3 or 4 indicators to determine what your trade ideas are going to be, or just outsource it to the person themselves and let them do it, or outsource it to an algorithm. Everybody knows you're short on time, and they're taking advantage of that and telling you what you want to hear. From a professional perspective, it's the dumbest thing you'll ever do. The best thing you can ever do is work out a systematic process that's rooted in fundamentals, that's repeatable. And then do that for 8 to 12 hours a week to begin with. And when you get used to it over time, it'll become easier. And we we have seen all sorts of people come through our process, and it generally takes 3 months to start to get used to it.
So Gabo's question is there a situation where you don't consider the PE ratio of a security? I think that I kind of touched on that in theme number 3, but there are certain industries where earnings essentially don't matter. It's trading on a different metric. Like in growth names, it's all about revenue or customers or some other metric. So it's not. As most companies, their PEs matter. In some industries, it's all about the growth. Anton, do you have anything else to add on that?
Yeah, I mean, in certain industries, balance sheets are very important as well. So, industries with large amounts of debt, it's important to obviously look at balance sheets as well. So, the way you've got to look at a fundamental systematic process is there's a period when you go through the process where, because you have so many stocks in the world, you have to have some sort of systematic process to drill down through all of the stocks to identify ones that could look interesting. Okay, so if we're looking at the world, there's 42,000 stocks on the planet, and there's filters and metrics that you would look at systematically, like PE, earnings growth, PEG ratios, stuff like this, that basically will drill down through 42,000 stocks, through certain sectors, that will pop up and give you, a whole list of potential ideas that you've filtered for in your process. Now, just ticking the boxes isn't good enough. You can't then look at a whole bunch of stocks that have popped out of a box ticking process and say, okay, that looks like the best one, I'm going to put a trade on. You then have to move from that quantitative process and the filtering process to a qualitative process. And the qualitative process is basically researching a company, researching a stock, and all of its background, and understanding the company first, understanding everything about it, understanding all the parameters that are important, and then trying to predict the future. And then also looking, like we did at the market earlier and the PE, saying the valuation that the market puts on this, is it justified? And after you've done all of that work, you may get to a conclusion where the conclusion says, okay, the background of the company I know everything about. The box ticking I did before and it popped up, and the market's willing to pay for this stock. Okay, let's say it's on a premium to the sector, right? Let's say it's got a much higher PE than the sector, ridiculously good earnings growth forecast by analysts, ridiculously high PEG ratio, so the market's paying a high multiple for the earnings growth relative to its sector, and a whole bunch of other metrics are good as well. And then you'd move to the qualitative side. And the qualitative side says, okay, the background of the company is sparkling, management is sparkling, product or service is sparkling. The future, in terms of earnings estimates, we know is going higher. But do the fundamentals of the company looking forward support the valuation story? And it's more likely than not that it will be. So this is why, when we discussed earlier, cheap and expensive stocks. Well, a stock can just be expensive forever, and a stock can just be cheap forever. And if there's one thing you take away from today, just remember this one saying: a stock is never cheap and never expensive. There's no such thing. It doesn't exist. Because a stock that's expensive is expensive for a reason. And a stock that's cheap is cheap for a reason. Think about it like this. Every day when you open your trading account and you look at level 2 in the market, an expensive stock, there's a guy on the bid buying that stock every single day. And they're buying it for a reason. They didn't just wake up one morning and take a ball out of a hat and play let's buy a stock lottery. They've done their work. And the market's buying that stock. And the market's telling you that they're willing to pay the price every single day for the earnings of the company. And if you argue with that, you're arguing with the market. And the same vice versa when stocks are cheap. So just remember that there's never an expensive stock, never an expensive cheap stock. It just doesn't exist. If you do that as a contrarian over many trades, back test all of those things, with bull markets in the past and bear markets, you're going to get run over. You will be out of the game within one cycle. Your job really as a trader is to try and make money from today till retirement and stay in the game and always win. And not to trade for one cycle then blow up. And if you're going to be consistent, that's the approach that you have to take. Systematic approach, structuring trades correctly, timing trades correctly, good risk management, and part of that approach is never believing that a stock is expensive or cheap.
Nicholas L's question is, how do you determine your risk management? How much time do you give your thesis to develop before you exit your longs? And would you still consider rolling if you believe in your thesis? Certainly, I would consider rolling my thesis. How long? It's always a moving target. Generally, we target 1 to 3 months, but just because it hasn't worked in 1 to 3 months doesn't mean that you should just give up on it. But you always want to look at every trade like you have no position on. Like you want to, every time if you enter a trade, exit a trade, want to double up a position, you want to look at it like you have no position on, rather than what you have on. Is that fair?
Yeah, I mean, in terms of, I think it really depends on your repeatable systematic process and the time horizon that you're going into the trade on, and envisaging when the trade should actually pay you. So, for example, if you're a day trader, I wouldn't advise day trading in a market when volatility is really low, because you're just chasing a phantom return that doesn't exist. But let's say volatility's high and you become a day trader for a couple of weeks. You're entering trades on very short time horizons. If it's not working in 2 or 3 hours, it's probably not going to work. So you should trade out. The same with portfolio management. If you go into a trade with a 1 month to 3 month time horizon, personally, I'd like to see in the first 4 to 6 weeks at least a few percent return where I'm getting paid. And if I'm getting paid after 4 to 6 weeks, then that's nice. I'll just run the position. And if I'm getting paid really well after 6 to 8 weeks, I'll probably look at ways to ratchet the risk and get a bigger trade on. But it's also dependent on everything else in your portfolio, right? So, like Raj said, you should look at every trade as if you have no position. Well, if you're running a portfolio, it's slightly different because your portfolio overall is a position. And you have to have a risk management strategy for the overall portfolio as well. So imagine going into the year January 1st, and your intention is to build a $1 million portfolio and try and make 15% in a year, okay? Where's your cut on the portfolio? How much do you have to be down before you give up? So you have to have a plan at the portfolio level, not just on the stock level. And because of that, when stocks when you're looking at stocks individually, you have to have soft targets and soft stops, but then initiate hard stops when you're making money. Because if things reverse and you get drawdowns, you've got to trade out. So yeah, happy to roll things and get bigger, but in the context of a portfolio, it's quite different.
Okay. And the next question: as a retail trader, Mark Z, do you follow big money trades? I think you mean do I just follow what big institutional trades go up and just piggyback on them? That's not really what we do. That's that if you want to do that, you can follow the Nigerians. That's what they do on TV. They just look at what big option trades go on and they just piggyback them. That's
what you're doing there. What you're doing there is relying on other people for ideas, and it's basically death in trading. If you wake up every morning and you're basically trying to just piggyback off everybody else, I mean, you don't even know why you're in a position. And when it goes wrong, you'll just cut. And one of the worst things in trading is that, let's say you have a long and you think a stock's going to go up, and then it goes against you short term, and you cut it because you don't even know why you're in the position, and then it goes up 300% in the next year. You basically missed a massive opportunity because you couldn't be bothered doing any work. So you've ended up being right, but you got stopped out because you're lazy and stupid and trying to piggyback off other people, right? So this idea of like just going long and short stocks because some other guy in the market did so, it's not a sustainable approach to trading. You'll just blow up at some point.
Yeah. A friend of mine owns the company that's called Option Alert, but basically everyone that buys the service just sees what big option trades go up, and then they piggyback them. And I spoke to him recently and asked him who's making money on this. It's obviously just him, the guy that's selling the service. So, okay. Jump in mining stocks after the Fed announcement. Actually asked me a market view. We'll skip that one for now.
Hey guys.
Yeah, we don't want to give any specific advice on.
Yes, that's.
Raj, Anton,
You want to give?
how are you?
Yeah.
How are you energy-wise? At this point, you've been going on for quite a while on the questions, and we really do appreciate it. But I want to do a health check. We can wrap up here and have you back another time. That would certainly be beneficial for.
Yeah, I think so. Makes sense.
All right.
Okay.
Yeah.
That's wonderful. Thanks.
Well, guys, listen. Thanks for attending today on the webinar. And listen, if you really want to ask questions and hang out personally, there's no better way to do it than going to a seminar. So if you look at the screen there, you can see all the dates coming up. Just register. It's free. We have a free ticket allocation. Turn up. Everyone goes for drinks afterwards. We put our card behind the bar, and we like to get to know our students one-to-one and properly mentor them and help them over a long period of time. So get yourself to a seminar and ask any questions you want. It's a very open platform, open forum.
All right. Well,
Yep.
on behalf of TradeStation, I want to thank you so much for helping us out today with our presentation or with your presentation, I mean, and to all of the customers and prospects that have attended. I hope that you found what you need here at with this webinar. The Institute of Trading and Portfolio Management, their website is, I'm going to post it in the chat panel for us right now, and please take a look at it. They put a lot of time and effort, and they claim it's one of the most comprehensive online trading education courses available in the entire world. So let's take advantage of that, and I'll be back tomorrow morning for TradeStation's morning market briefing, 1/2 hour before the opening. Thanks very much.